All right, good afternoon. Is this on? Yes. As mentioned, I'm Kennedy Hicks with Eastdil Secured. We'll let everyone. Excited to be here, based in Atlanta, but cover the Sun Belt for Eastdil and spend a lot of time in Florida. Also a Georgia grad, so not sure how I got in here, but I like that you guys do this event. So we've got a great group of panelists here today. Each of these gentlemen is very, I think, offers great perspective in terms of what's happening in terms of broader capital markets transactions and getting deals done, and then also finding opportunities in a constantly evolving market. So with that, to my left is Dave Dowell. He's a managing director with RHôNE Group. RHôNE is a global private equity fund, and Dave came over a couple of years ago and co-founded their real estate platform. To his left is Robert Klein. He's a managing partner with Monday Properties. They have a large portfolio in both DC and New York, but he's got a lot of other experience in the past 20 years with capital markets transactions. And then to his left, Jim Heistand. Jim's the president and CEO of Parkway. Parkway is a name that's well known in Orlando and has continued to evolve. He's been busy the past couple of years, transitioning the company from a public REIT to a private company. So with that, I'd like, I guess, each of you just to give us a little bit of insight as to sort of what you've been up to the past year or two in terms of the bigger deals you've been involved with, and then we'll kick off the conversation. Dave, you want to start?
Sure. The RHôNE Group, for those of you who don't know, which is probably almost all of you, is a 25-year-old private equity firm, which up until a few years ago had never been in the real estate space, focused mostly on mid-market industrial and consumer acquisitions with an international bent. When they came upon their 20-year anniversary, decided they wanted to sort of broaden the reach and go into other sectors. They've been sticking to their knitting the whole time. They brought myself and my partner over to found the real estate group. We set about very quickly building out that platform, purchased about $600 million worth of value-add real estate, all domestically, in the first 8 months that we were there. Sort of simultaneously to that, RHôNE, through a relationship with the founder of our firm and the founder of WeWork, formed a strategic partnership to launch and raise a separate private equity fund in conjunction with WeWork to go out and purchase assets that WeWork would be a tenant in. So sort of built two businesses for the group over the course of time. So been dabbling both in the original business on the value add side, kind of across all asset classes, and then getting the WeWork fund up and running.
Great. Robert?
Thank you for having me, everybody. My name is Robert Klein. I'm a managing partner at Monday Properties. We are an owner, operator, fully vertically integrated construction, development, property management, cleaning, the entirety of the operations stack. We own and operate assets primarily in Washington, D.C., Northern Virginia, New York. That's our focus, and the radius around those. We currently have a portfolio that's roughly $1.5 billion to $2 billion of assets, heavy on office with some multifamily, in particular development there. We are a company that's been around since the 1960s. The founder of our firm, his father had started what is today known as Rosslyn, Virginia, as an office market, which really fed off of the federal and then the local government. It was a place for them to go for quality real estate that he could build to suit at prices that they could afford. That market has grown today to about 9 million square feet. Recently, Nestle's U.S. headquarters has moved to there. It's got one of the highest concentrations of millennials, educated workforce in the nation. It's a transit hub, and it is extremely close to Washington, D.C. So that's where a lot of our focus is, down to kind of the Dulles Airport, and then into Washington, D.C. We have about 120 employees, and we're really capitalizing now on the emerging trend of capital overseas coming and backing operators directly. So that's kind of the background, I guess, on us.
Jim, it's been a Busy 24 months?
24 months, yeah. So we went
six
from,
years?
actually 6 years. We went from private to public to private during the past 6 years. And currently, we are a private company with 9 million square feet of office just in Houston. And how that evolved was, Parkway was across the whole Sun Belt. And then I took over in 2012, and TPG co-invested when I took over, and the goal was to grow the company, turn it around, grow it, and then ultimately monetize it through merger or sale. So we set about doing that. We bought over $4 billion worth of assets during about a 3-year period. And we were in conversations with Cousins at that point to do a basically straight up merger of equals. For me, it would have been a great opportunity because I would have no longer had to be CEO of a public company. When it went into the chairman's role, Larry Gellerstad, of CEO, would have taken, the CEO of Cousins currently would have taken that over. And everything looked like that made a lot of sense. While we were having discussions, however, the oil market tanked in Houston. Cousins had 43% of their assets were Houston-based. We had about 24%. So we basically backed off of talks. As a result, we didn't want our shareholders to get more Houston exposure. And the problem in the market at the time was the public markets gave very little value. In some cases, we traded at no value for the Houston assets. I mean, we knew they weren't worth zero. So we sort of went back to the drawing boards as to what ways to, create back the value we had done for the shareholders. And actually, Jason Bates, who's my Chief Investment Officer today, was the same Chief Investment Officer at Parkway. What about if we did a merger and we spun off their Houston assets together with ours? So you'd have two different companies, one a very pristine portfolio, because all the assets that we had purchased were very complementary to Cousins' portfolio in Buckhead and Charlotte, Austin and Phoenix, Tampa, Orlando. So I told Jason, give him a call. We knew, though, that if we did that, of course, we were the ones going to run the Houston portfolio, and they were going to have the pristine portfolio, or they wouldn't even discuss it. And they actually thought that made some sense. We did, too. So Kennedy's firm helped us with this. Took us almost a year, because really what you were doing, a merger and a spin, it was akin to an IPO for the new company in Houston. So we accomplished that. We spun it off, and then shortly, and then Cousins really traded extremely well, because untethered by the downturn in Houston, all the other assets were trading at historical highs. They traded at or above their NAV, and our shareholders had 70% of their value in the Cousins shares. And so the Houston market began to get a little bit firmer. We brought in a JV partner, a CCPIB out of Canada, to do a joint venture with 57% of the assets at pricing higher than what we thought we would trade at. And then shortly thereafter, they decided they wanted the whole portfolio. And so what we ended up doing was a take private, where they bought the entire company. We co-invested with them in the assets in Houston. And then we operated the private company, so we entered into long-term management agreements and leasing agreements that run the portfolio in Houston. So in effect, back to where I was 6 years ago with a private entity that has capital partners. And at the end of the day, our shareholders probably had a 30% increase in the value of their shares as a result of all this machinations that we did. So it worked for all parties. TPG was able to monetize and get a 2x multiple on their capital. They were happy. We bought Thomas Properties. He was our chairman. His shares have appreciated. So I thought at the end of the day, we found a way to get it done in a very difficult market.
Absolutely. It's a great story. Working through that big deal, obviously you mentioned Houston and the impact that had as it relates to timing. But I guess going back to when you were first contemplating the merger with Cousins, why was then the time? What made you say this is the right time to go merge these two companies?
Well, my personal opinion is, if you're going to be public, you need to be large. I mean, I think smaller public companies, the G&A load erodes the value. You have no float in your stock. So philosophically, we thought having a larger company would add value. All of the markets we were in were complementary to theirs. Houston, before the turn, of course, did quite well. And so our view was, a very, very large company in the Sun Belt with high concentration, great quality assets would just trade better than us individually.
Makes sense. And then
and the issues with those always are social.
Right.
Generally, that's the biggest problem. And for me personally, I didn't intend to be the CEO of Parkway originally when we sold. So the fact that I was willing to give up that seat gave us something to trade, and that's why one of the reasons we also wanted to do
Makes sense. And then as you worked through the Houston co-deal with CPPIB, bringing in a large Canadian fund like that, I mean, any unforeseen challenges or anything that came out of that was
Lots
lessons
of
learned?
challenges came through it. I mean, this was a first for them. I mean, to the point earlier about foreign capital wanting to come directly with operators, that's definitely the trend. As opposed to them putting money into a fund, they wanted to deal directly with the operator because in effect they're cutting out another fee component that they'd have to pay. So for them, though, they had never basically bought a whole public company themselves. They might have provided capital, but they were actually the acquirer. They put the full faith and credit of them behind the offer. And then what they'll do, and they're in the process of doing, is they'll syndicate 49% of it to probably another foreign source. And they've got lots of interested parties to do that. But, it was a challenge for them because it was the first time they've ever done that. And as you can imagine, there was just lots of things to work through.
And I guess it could be good and bad that they already have a significant energy exposure in Canada, but how did that play into just the overall Houston
Well,
thesis?
I think long term, they were bullish on Houston. I mean, I think in the short term, without a doubt, but if you look at the values today from when we announced that trade, I mean, the values are up from when they first bought. So I think they made the right bet. And I think I just saw the stats here on the gentleman before that Houston was #1 over the next 2 years in office jobs creation. I hope that's the case since we got 9 million feet there. But I think they were just long-term that. And, it was funny, they had just sold $1 billion asset in Manhattan. And if you look at the metrics, what they sold that for and what they could buy into Houston at, my view too, the reason I took over the Houston portfolio and did this was we were in effect selling the cousins assets that have been doing in these markets for many years. Were trading at historical highs, and we were buying into Houston at pretty cheap numbers. So I think they bought into that same philosophy.
Makes sense.
And we kept the entire team in place. We actually kept all of our public accounting reporting functions so that it gives us the ability and the platform to continue to expand.
I know Dave and Robert, you guys have worked together previously on a large portfolio sale as well. Maybe elaborate on that, and then we can get into some of the complexities that occurred during that transaction.
Sure. Previous to the RHôNE Group, I was at a firm called the Palladium Group. We had invested the bulk of our seventh fund in a relatively large multifamily portfolio, starting pretty much in 2009. So the timing was very good. We had a tendency at focusing on smaller assets. So we had a portfolio of about 36 assets, 11,000 units scattered across the country. And we had invested it earlier in the cycle, and we decided, there was a point in time where we figured we were well in the money and it was time to harvest. And the head count of the shop, we had 4 acquisition guys, 3 acquisition guys. We do all the asset management ourselves. It's sort of been the way a variety of the employers I've had over the years. And looking for an efficient exit on 36 assets scattered across the country was daunting. We didn't necessarily want to get rid of them all at once, but we started exploring that. And Rob and I were having lunch one day, and I was sort of picking his brain. He at the time was at this was prior to your Evercore, prior to your time at Monday. And he's like, well, why don't you sort of suggested we explored a bulk sale and suggested that they, was something that they could handle for us. And so that was sort of the germination of that thought. And we ended up trading out in one big bulk sale to Blackstone at a total value was what, $1.7 billion?
$1.7 billion, yeah. Yep. But it's interesting. Jim touched upon a point of there's social issues around any large deal, whether it's a merger or a portfolio sale or a change of someone's livelihood by having to change their business. And that's something, I used to be an investment banker for about 10 years, and it's something we've really focused on because mergers and big deals are made by people. They're not made by assets. They're not generally made by investors. They're made by the people that are going to be executing the deal. And this was a perfect case of that where Dave and I were able to talk before and during and after the transaction to really help through what were some rocky times during a transaction of that size, where there was a scattered field, and by having constant communication, a good friendship, open dialogue, we were able to make a tough transaction work.
And we've hit on the subject of just more and more foreign capital looking for oftentimes big deals, platform plays. Obviously, Blackstone not ultimately foreign, but did you see that in this transaction?
Yeah, so there were a lot of folks, a lot of groups internationally and domestically that were sniffing around the transaction, that had interest, that signed confidentiality agreements, that did some diligence. But when it ultimately came to the end where they had to put up their bid and stand behind it, there were probably 2 or 3 groups. Some of them were only for parts of the portfolio, and that was part of the discussions that Dave, his management team, and I had to have were, how do we want to do this? Do you want to try to maximize price, but with less certainty by matching 2 or 3 different groups together? Or would you rather have slightly lower price, but the most capitalized group in the United States, and Blackstone being, the ultimate buyer of the transaction? And, those were parts of the discussions we had. For a transaction of that size, and a few years ago, there really were only a few groups that could do it by themselves. So ultimately, I think we all decided as a group to give Blackstone a shot, to try to push them a little bit in price, to get them very close to where we could have potentially sold it in parts, and do a transaction that had high certainty of close.
Makes sense. All 3 of you, I think, are in maybe slightly different roles, but are actively having dialogue with partners, be it operating partners, capital partners, just sort of given some of the things we've already talked about, social issues, et cetera. I mean, when you think about bringing in partners today, what do you look for? What's most important? Is it cost of capital? Is it relationship? Is it alignment of interest and of time frames? I'll let Dave start with.
I'll speak for ourselves. We're a capital provider, so when we're partnering with folks, we're partnering with operators. And I would say the number one criteria for us, first and foremost, above almost everything else, is the relationship, because you're entering into a very long-term relationship. Something will go wrong, probably on a monthly basis, or twice a year. Something always goes wrong in an equity investment. And you need to be able to rely as a capital provider when we are, in many ways, we're providing or promoting our operating partners based on their ability to execute on these plans. But we take a very active role, and we really need to trust them. And so, I've had partners over the years where, you're constantly trying to follow up with them, and you can't sort of get the answer you want. And even if the deal does well, I'd rather not necessarily do business with them again. Whereas I've had deals that during the downturn, the market sort of went away from us, and through nobody's direct fault, the transaction didn't do well. But those partners were on top of their game, were keeping us in the loop, were making sure that they did right by the assets, and I will do business with them again forever. So I think ultimately it's as large a space as real estate is, as large a sector as it is in the country. It's quite a small industry, and those relationships are critical, and having good ones are gold.
Robert,
maybe I'll add on to that. I mean, for us, the number one thing is going to be ease of transaction and trust, but the ticket for entry is certainly cost of capital. There is a stage at which the cost of capital makes a deal unattractive. But once you've kind of hit that threshold, it's very much about doing business with people that are going to perform the way they say they're going to perform, that aren't getting bogged down in legal documents, but more about the personal relationship and what's right for a deal. And that takes a while. You have to be around the industry for a while to figure out who does that, who retrades, who's going to be there in bad times, who's only there in good times, who you can repeat business with. And that's kind of, I guess, the second or third point for us. We're trying to keep our lives a little bit more simple and not separately capitalize every deal that we're buying right now. We're trying to repeat with our capital partners. And so if I'm just going with the lowest cost of capital, that probably will change on a deal-by-deal basis. China was the cheapest cost of capital for a long time. They no longer exist as a source of capital. And so, for us, our life's too short to be chasing the next best, cheapest source. So I think that those things for us are really important.
Yeah, I think all those points are valid. For us, we never raised discretionary funds, so we tried to pick partners that we could do repetitive deals with, because we're more efficient out finding the opportunities and then operating them. So ideally, you want to find a partner who has the same investment strategy that you do, and then our job is to go out and find the opportunities and execute on them. If you go from deal to deal, different partner to different partner, it's extremely inefficient. It's very difficult to do. And some of the bigger funds, very hard to get a CPPIB to go put money into a brand new deal. This was more of a captive or sort of a recap. It's much easier for them. So you've got to have partners who can move quickly, because the opportunities that come up sometimes to get the right pricing is more timing and speed. So you need a partner that you can do repetitive deals with. You have the same strategy going forward. And you might have two different partners for two different cost of capitals for more opportunistic plays and more core plays. So you've got to match that up. But once you do, you ideally you're performing, you're staying with the same partner, and you can do a lot more transactions if you're using the same people every time.
Robert, you said in New York, you mentioned the Chinese capital controls. Curious, just with all the press in the past couple of weeks, what's the sentiment? Is that going to create opportunities, or people? What's the feeling on how that's going to have a ripple effect through New York and probably other markets as well?
It's already happening. I mean, we've all, I assume, read the press about H&A. They were one of the largest buyers of New York City office assets over the past couple of years, including 245 Park, which is a very large deal. Nobody knows what they're doing now. It is assumed that they're going to sell all of their assets. There are assumptions that they'll sell parts of them, they'll sell some of them. They're in a transaction on one of their deals right now where the thought is that the purchaser of that deal is going to buy the remainder of the portfolio. What is going to happen from all that is it will certainly affect pricing, because they have bought those assets at a price that most of my colleagues, most of the capital I talk to, and most of the folks that I do business with do not agree is a market price. It is above market price. So that will provide, a slight correction in where the market really is versus the outlier buyer, because a lot of the brokerage firms, including Eastdil, in New York, will all agree that there are processes that have a ton of bidders coming in, a lot of potential buyers, and then there are processes that have a few and an outlier. And that price, if that outlier doesn't transact, is significantly higher than where the market is. And once you remove that outlier, the H&A, the Anbang, the other Chinese groups that are no longer there, you have to either find another outlier or the market corrects a little bit to where the rest of the field is.
Yeah, we're definitely seeing and hearing a lot about that. I think it also created a little bit of a discrepancy between buyers and sellers for the past year or two, particularly in New York. Mm-hmm. Dave, I don't know if you have anything to add to.
Yeah, look, I think that's exactly right, particularly for some of the larger transactions. I mean, going back to ours, we didn't go out to a field when Rob and I did our transaction with 20 bidders. There was, a handful. And if there's one that's sort of skewing the math, once you remove that outlier, it does create an adjustment.
You mentioned the WeWork Property Fund that RHôNE is a part of. Maybe give us a little bit more color on what that fund is and the opportunities that you're seeking.
Sure. So WeWork historically has been, they've been around for, I guess, started in 2010, a little frustrated by the fact that they feel they created a significant amount of value. I think they feel correctly. They'll go into a building that may be 50% occupied, and they'll lease up the remainder of the building, and the landlord would either refinance out all his money or flip it for a big profit. And they've felt a little frustrated that they feel like they've created a lot of that value. They haven't been able to capitalize on it. And so through the relationship, and again, it goes back to relationships between the founder of RHôNE and the founder of WeWork, they said, maybe there's something we can do together now that RHôNE has started a real estate team to go out and try and profit from some of the value that we being WeWork, create when we enter into a property. And so the fund was raised with the basic premise of that we can go out and look at a building that it's 40% vacant, and we know day one that we have a tenant that's going to take that property from 60% occupancy to 90% occupancy. We should be able to pay $1 more than everybody else, get the same return for quite a bit less risk. And so that's sort of the premise of the fund. And look, there's going to be deals out there that WeWork wants to be in that are either not for sale or too expensive. WeWork's going to go and lease in those properties. They're opening 10 locations a month no fund on the planet is ever going to be able to keep up with that kind of growth. But where is a deal that the pricing makes sense, WeWork wants to be in it, the fund can go out and capitalize, and we feel anyway, get a good bang for their buck.
I personally spent a lot of time fielding questions about the co-working space and what that means to investors and how people are responding to that. Curious, as landlords, Jim and Robert, are you making adjustments in how you think about amenities, how you think about leasing to co-working space? Has it affected the way you build out spec suites? What's your theory on?
I think we've used a component of all of those things. We've done the shared conference rooms. We've done the the WeWork space in some of our properties. We've got some element of that in each, and we've done the spec suites, and some of it, we're considering doing ourselves, a component of it. What you worry about on some of that, if there's too much of that, what is the residual value? Because you've got shorter term. If you're doing some of yourself, is what I mean. You may get a better net rent, but you're not having long-term leases in there. So how does that get calculated upon sale? I mean, I think it's sort of evolving right now to see how that all plays out. But there's definitely a need from the tenant standpoint. If you don't provide that, don't provide the flexibility, don't provide the amenities, it makes your properties uncompetitive. So we've utilized all of that throughout all the properties we have in Houston, to some degree or another.
Yeah, I agree with that. I mean, shifting a little bit and then going back to the co-working, the amenities have been a large focus of Monday Properties. We're making sure that all of our assets have a good gym, a good conference facility. Sometimes we're running that ourselves. Sometimes we're outsourcing it to groups like Convene and others to have a competitive product. Because absolutely, Jim's right. I mean, tenants are now looking for more of an experience than just going to work and coming home. They want other stuff within their building, food options and conference options and other things. But the co-working, it concerns us. I mean, we have co-working groups as tenants. Regis Spaces is a large tenant of ours in our portfolio in Northern Virginia. We're believers in the space. When we underwrite assets, we're always thinking about, is there some vacancy that would be suited for co-working space? It's a reality. It's a need, but you have to be careful that it is not your only tenant that you're relying on, because two of the issues that come along with co-working space are the reuse of the space. There's not a whole lot of salvage value, so you have to be careful how much TI you're putting in, how much work you're going to invest into that space that you will never get the value back from, but for the lease. And the other thing is, depending how much space you have and where it is in your building, the elevator load, because there's a lot more people per square foot in those co-working spaces, and so you've got to carefully measure that with the rest of your tenancy.
So thinking about where we are today, it's been a prolonged period of growth. Interest rates have remained relatively low, starting to see a little bit of an uptick in that. But I'd say from most people's perspective, the obvious opportunistic deals are fewer and farther between. Curious, as you've set out investment strategies for 2018 or beyond, have you changed in terms of either return requirements? Have you changed in terms of what you're looking for? How has the current environment affected what you look for in opportunities? Let anyone start? Jim, you want to?
Well, I think a lot of the newer money that's been raised has been a little bit more realistic in terms of the returns that they've promised the investors, as opposed to the 20 IRRs. You see more people in the mid-teens in terms of the fund expectations, because it is hard. It is hard to find those opportunistic deals. And what we found is it's kind of bifurcated. Where the opportunities are the larger big portfolio or larger transactions or company trades, and then things under $100 million. In that $100 to $200 million range, there's plenty of money chasing them. But with that said, most of our markets in the Sun Belt, for the office component, and in certain submarkets, there's been very little office construction. I mean, it's one thing you can get a spec apartment building financed all day long, but you can't get a spec office building financed. So most of those markets seem to be relative in balance, and if the job growth pictures continue as forecasted, they should continue to do better, but not to the point where you're going to see the kind of the 20 IRR deals as a result of it. So it's not a macro bet now. You've really got to pick your spots as to where you do it and which submarkets and what type of assets, and it's not easy to find them today.
Yeah, in our markets in particular, when you look at Washington, D.C. and New York, it's really hard to look yourself in the mirror and think that you're going to find a 20 IRR that you didn't do something very aggressive to get to that kind of return. Even development, we're doing development down in Charleston. There we can start hitting 20 plus returns. But once you start getting north of Charleston, where the large job growth is and the factories are coming in. But in New York and D.C., we're seeing returns on office somewhere between kind of 12s and 14 IRRs on 5 and 10 year type of holds with value add, with some lease up, with some projects, some amenity improvement to do. And that's realistic. The problem is that a lot of capital is guarding itself and wants to see slightly higher returns, wants to see that kind of risk, a 75% lease building going to 90+%. They want to see high teens so they can net out to their investors the 15 or 14s. So there definitely is a gap between what exists on a logical, conservative, achievable underwriting and what some of the capital that we've traditionally talked to is looking for. And that's why a lot of our capital recently has been coming from overseas, groups that are trying to get into the U.S., and those types of returns with some cash yield are quite attractive versus what they could find elsewhere in the world.
The value add side of our business, I think it's been very tough for all the reasons just mentioned, make the numbers work in major markets. And so what we've found is that going after smaller sized assets in secondary markets, well, certainly competition is as high as it's ever been, and cap rates are compressed sort of across the board. They're less so in secondary markets. The competition you're facing isn't necessarily from a large institutional investor. It's not from foreign capital almost ever. And so in that area, a shop like ours, which has flexible capital, which can move quickly, we found that we have a little bit of a competitive advantage by going to those secondary markets. And coming from New York, there's a lot of capital in New York that forgets that people live in the rest of the country, that there's cities in America where people like to live and work, and there's jobs there, and so you get sort of a myopic view on the coasts that if you can sort of step outside yourself and say, look, we're going to go into these secondary markets. There's good infrastructure growth. There's good job growth. You can find opportunities still, not to the 20s, sadly, but to those mid-teens.
And you must see it, Kennedy. We've reached out to sellers, kind of, would you be interested in selling? And a lot of people don't want to trade today. I mean, because they don't know where they're going to put the money if they trade, right? So there's not a lot. I don't know what the stats are, but we haven't seen that much transaction volume. And when we talk to owners, and their comment is, if you could find me somewhere else to place the money after you buy this, and so it's a challenge. So things are fairly well priced, and nobody seems to be looking or needing to sell. And there's been plenty of money raised to invest.
Yeah, I mean, I think I absolutely agree with that. I think there's a lot of money looking for opportunities, and the product is either traded or people feel like there's still some time to go perfect it at the asset level if waiting on a big lease or trying to get through the next renewal. I actually think, too, that the Amazon HQ2 search is affecting it a little bit because people that own in one of the top 5 markets are like, well, might as well just let this play out and see what happens, and not be the person that sells right before some big announcement. Not sure that's, but I'm hearing that a little bit in Atlanta in particular.
Refinancing's been the big mitigator too. I mean, that's been everybody's backup bid. If they don't get the price they'd like, I'll refinance. And that's going to start changing if interest rates keep ticking up, because all of a sudden the price equivalent to where they'll refinance comes down. And so I think that might change the dynamics a little bit.
Yeah, that's a very good point. I think last year we saw a lot of deals just quickly hit the refinance button because the appraisals were coming in maybe 5 to 10% higher than the bids at the time. So with that, are you, and given the interest rate environment, is that changing the way that you're levering assets? I mean, do you start going more towards locking down fixed rate financing today? How are you thinking about leverage?
We are. I mean, a lot of our business is governed by who our partners are, because they all have, they've got different hold periods, different tolerances, different needs for cash flow versus IRR. But in general, yes, we're trying to get interest-only loans We're trying to, lock them in fixed. We don't want to have the floating rate exposure, so we're swapping them out or going fixed right off the bat. We're definitely, I wouldn't say, we're cautious about where interest rates are going to go, and so we don't want to take that risk. And a lot of the things that we're buying have a value add component to them, so that's where the value is going to be, not off of the off of rates coming down. We're not banking on that happening. So that has certainly been our strategy, and we're actually for the first time now considering rate locking on a deal before it closes. And so that's not something that was ever in the vernacular of our business, since I started.
Jim, you didn't used to have to deal with that as much on the public side, but going forward, how do you think about financing assets?
Well, I mean, we always try to match the financing for whatever the strategy of that asset is. If it's a shorter term hold or a longer term hold. If it's a shorter term hold, we're gonna go floating with some extension options, hopefully. But depends on the partner, right? CPPIB, their 50% max is what they all want. That's the most leverage they'll put on. And I think we were only 45% in the trade they did with us. But if you talk to some of the other groups we've talked to, they want to push it to 65 or 70. So it just depends on who your partner is with that, and the kind of what the strategy is for the asset. What Parkway used to do is they just got long-term debt, and there was no strategy for the asset. So if that asset needed to be liquidated sooner, the defeasance and the cost and the penalties were excessive for that. So we always try to marry up debt to whatever the asset strategy is.
Do you have any thoughts on?
I mean, similar. We've generally been partial over the past few years anyway to floating rate debt, but matching. I would agree with both these gentlemen. Matching the debt to the strategy is critical because you never want to exit when your debt sort of makes it prohibitive to do so.
What about? There's a lot of talk in the previous presentation around technology and healthcare. Are you guys forming ideas or initiatives around assets that have more of a healthcare component? Is there where do you see an opportunity in that regard?
I think there's two sort of aspects to it. One, the driver that healthcare has in any particular market, and particularly when you get into the secondary markets, almost without fail, the largest or second largest employer in that market is some type of health system. So assessing sort of the strength of that health system and how it impacts the particular property that you're buying is critical. Second to that, of course, is investing directly in healthcare properties. And at least for a shop like us, where we have the flexibility to invest sort of across asset classes, we're only going to do that alongside a partner that is an industry expert. Right? So we're not going to go necessarily invest with an office operator in medical office if they've never really done that before, because having a relationship with that local hospital system, that local healthcare system, is critical in the medical office space. So I think it's on everybody's radar, certainly when you get outside of the major markets, because it's such a dominant presence.
Yeah, I think we have it as a component of strategy, not as a specific strategy. At Monday Properties, we took back a portfolio in Alexandria, which is in Virginia, and it was all office, and we realized there was a medical office down the block that was overflowing and had tenants that didn't know where to go. So we've converted now one of our buildings into medical office. It was 5 buildings. One of them is now exclusively medical office. And so we were able to capitalize on overflow of demand of tenants. And then we're looking at some other assets, a couple in Brooklyn, one of which has bottom floor space that you worry about the retail environment today, but it's a very logical, for an outpatient type of medical office for that bottom floor usage. So we're thinking about it as parts of our tenancy, but we're certainly not chasing the thesis.
And then on the technology side, I mean, as you alluded to, a lot of the deals that we've talked about, they come together person to person. It's still a relationship business. Real estate as an industry is probably pretty behind in terms of technology, but you are seeing avenues like auction.com and other sites try to create a gap or figure out a different way to get deals done. Any thoughts around how technology is going to continue to influence the way that these deals occur?
Yeah, I mean, 10X, who's auction.com, is certainly growing in the space. They're trying to take some of the repetitive nature of the acquisition process out of the hands of individuals, but I don't think that they have quite got to the point where they can replace Eastdil or any of the larger shops. There's a ton of value that needs to be added during a sales process. But where I see technology changing is definitely in the use of space, I think more than the way a transaction's happening. We've been looking at a group that is taking multifamily assets in Manhattan and trying to make them into these micro apartments for kind of students coming out of school that want to move into Manhattan, but can't afford really a doorman building, which is a common thing in Manhattan, and they've replaced that with technology. So there's a way to receive packages, there's a way to see who's coming into your apartment, to let people into it and out of it. And so that's where I see technology changing real estate, and it's starting to be adapted a little bit more.
I think I would agree with all that. I was at another conference a couple weeks ago. Someone was up. They had a panel of sort of real estate technology folks, and one of them was talking about essentially trying to make like commercial loans, quicken loans for commercial loans, so you could make it a much more efficient, much more technology-driven. I have my personal doubts about that particular avenue, but there are certainly very smart folks trying to figure that out. I think one area where it could have an impact, and I don't quite know when this will happen, but if driverless cars actually become a thing, so much of suburban office is driven by the type of parking there is, its access to transportation nodes. I think that will have a very interesting, and I'm not quite sure in what direction, but it will have a very interesting impact on a lot of office that now no longer has to worry about all this parking. Certainly on big retail centers where they have all this parking now, what do you do with it if nobody's actually driving their own car? There could be some redevelopment plays there. So it's coming. I just don't know exactly how or when.
And we are also spending a lot of time talking about garages and how they're ramped and where they're located and how ingrained they are with the office building. I mean, is that playing into your thought process at all now, Jim or Robert?
Well, if you had to the point earlier, if you had an abundance of co-working space, you do need more parking for that because it's a higher density use. So how that balances out with people not driving cars, we don't know yet. But I mean, it's when we're looking at a property, how that parking interacts with the needs of those tenants in the building is paramount to how we evaluate it. But it's changing. I mean, we talk about technology, and I'm the last guy to have much expertise in that, but we're clearly spending a lot more on our buildings and technology. The other side of the coin is technology tenants too. I mean, we had a big portfolio in Austin before we sold to Cousins, and it was a lot of work to make sure those tenants, they sound good and they're growing fast, but the credit was lousy. So you had to get, tenant credit enhancements to make sure that, that they did that. So the technology is good in many respects. And fortunately, I've got somebody who handles all that, and we're trying to be on the cutting edge of it. I can't tell you what exactly that is, but we do spend a lot more money on it today, and we think about it a lot more.
Yeah, with the parking thing, a lot of our thesis is around transit-oriented. So while we have to consider parking, and it is an important part, we're a lot more concerned with the walkability, the access to mass transit. But I was also at a conference a few weeks ago, and somebody was talking about how they're trying to now, when they buy office buildings, think about where drones and flying cars will end up parking in front of the buildings, and considering that in their capital expenditures 10 years out, so that they don't have an obsolete building. I'm not sure I'm quite there yet, but there are definitely a few folks thinking about what's going to happen 10 years from now. How are buildings going to be different?
So Jim, I know you're not going to just be a Houston landlord for long. I said I know you're not going to be a Houston landlord for just a Houston landlord for long.
Having all of our bets in one city is not a great thing, but yeah.
So what's next?
Well, I think we look at it in the same markets that we had the expertise in, which again the Sun Belt. We were in Charlotte, but it was certain submarkets in these cities. So we were in Charlotte CBD, we were in Buckhead, we were in Midtown in Atlanta, we were in Austin. We still like Houston. I mean, it's funny, there hasn't been as many distressed trades as you thought, but there are some things that we're beginning to see. And there's now a lot of capital coming into Houston looking for these. We like Phoenix, so I think we've got relationships in all those markets and throughout Florida. So we'll continue to look for opportunities across that. We'd like to have a more balanced portfolio as we did before. So you could You could sell something in Houston when the market conditions are better, and you could add some other things, some other assets. So, we're looking across the same markets that we did before.
David, what other opportunities do you see? Obviously, the WeWork property fund's kind of off and running, I think, somewhat individually now from what you're doing. But what do you think's the next deal that's out there? What excites you going into this year?
I think Spencer in the last presentation was saying he was quite bullish on multifamily. I continue to be bullish on multifamily as well, and folks always need a place to live, and I do still think there's such a huge gap between the B space and the A space, and nobody builds Bs, that it's quite an obvious play, but there's so much of it out there. I'm quite certain we'll be able to find some stuff this year that makes sense for us.
Robert?
It's a little bit more of the same. We're really following transit spines and where transit's coming in. So, one of the big pushes we've made, and we're going to close on our first deal on this thesis this month, is there's a new metro line extension out of DC down to the Dulles Airport. We're following that along. We're buying properties that are right near the nodes that are going to come into play in the next 2 or 3 years, because we've looked at kind of the stats, and there's a nice run up in rent and occupancy the 2-3 years running into a new metro station opening, and then afterwards another bump. And so we're trying to catch that first and then second wave, and have about a 5 or 6 year time horizon on those type of deals. So that's been a big focus for us. And then we're always sharpshooting, within Manhattan and within Washington, and then around those markets, looking for distressed sellers, looking for opportunities that didn't trade. Most of our recent deals have been deals that had a failed marketing process, and then the seller came back to us and said, what's the price at which you would do the deal? And we've found a way to do a deal through the relationships where we started the whole discussion. So we're going to do more of the same. And we're also going to follow the thesis of some of our capital. So, one capital source that we've been working with, that we recently chased a deal with, was a net lease government focused group. And so we'll be looking at some more of that within the Washington area as well. So we're following capital, we're following transit, and then we're following, what I call distress, whether it is, for a short period of time or for a longer period of time.
I think, Kennedy, too, one thing I didn't mention, we are looking at trying to integrate kind of a multifamily platform into ours, since we have the back of the house, and because to the point earlier, technology is changing so many things, and it'll continue to change office, but we don't think it's going to change people needing 1,200 square feet. So I'd like to have some diversity and have some of that as well in those same Sun Belt markets, whether that's redevelopment of existing ones or actually ground up development. We'll look at that depending on the skill set of the people we bring in, but that's a component we'd like to add to our platform.
Interesting. Last question, everyone's favorite topic today. Any bets on where Amazon HQ is going to end up?
I'm not a betting man, but I hope it's in our backyard in Northern Virginia.
I would be shocked if it were the New York area. I know it's one of the finalists, but that would be utterly stunning to me. So I'm hoping Northern Virginia as well.
Thanks.
I think Atlanta's got a good shot, but
we'll see.
We'll see.
All right. Well, thank you. I really appreciate the discussion. We may have a couple minutes for Q&A if anyone has a question for any of the panelists, but I know there's a break right behind this. Okay.
I mean, each sub-market is different, right? So I think you'd underwrite each market based on where we think the health of that market goes forward. We always have our growth projections. I don't know that we're changing too much as what we look to going forward. We try to be cautious on that. So you can make an underwriting look great if you just jack up that rent growth. And then you go look at the residual, then it's kind of way what it is over what it would cost to replace. So you've got to balance that. So, we look at it, but I don't think we're being, we don't want to be overly optimistic in assuming it's going to continue to drive huge rent growth. I mean, I think we always look at our exit and do a higher cap rate on exit, assuming interest rates will continue to rise. So we always do that. We adjust for that.
We're in the same boat. I don't think we've taken to the tact of if interest rates go up, then therefore rent follows. I kind of view it almost the other way around, that things like rent growth and good things in the economy can affect interest rates the other way. So I think we take a stance on rent growth based on what we know of the asset, the market, the tenants, versus where interest rates are going. But it certainly affects our cap rate, our financing, which are two major assumptions within our underwriting.
On the multi side, I think there's been quite a trend over the past 8 years for everyone sort of looking to build multi downtown, because they said millennials want to be in the CBD space, live, work, play. I have 3 young kids. I used to live in New York City and no longer live in New York City because it's just you get cramped and it's unaffordable. And I'm of the belief that the folks that have sort of ridden off the suburbs are probably wrong, and that these millennials will eventually have children. They will eventually need to send those children to school. They will also be looking at their paychecks and realize, I can't afford to do all that where I'm living, so where can I do that? That's usually the suburbs with more space. And that's not to say that they're going to go buy a home necessarily there. There is a transient aspect to that generation that is greater than generations before, and I think that probably stays. So I don't think you're going to see a huge sort of spike in home ownership, because now all the millennials are looking to buy. A lot of these kids sort of came of age or during the financial crisis and are a little bit scarred by that. So I do think rental property is here to stay. Just where that is now, the trend isn't necessarily going to be downtown. It may gravitate back out to the suburbs in the near future.
Yeah, and I think as interest rates continue to rise, I mean, financing is still not that easy for somebody buying their first home. Right. And so if rates continue to rise, that's just going to put some people out of the purchasing market, even if they wanted to. So I agree. I think that I can't say what the supply demand dynamics will be for every market, but I think generally you'll still continue to see strong growth in the multifamily field. With that said, Orlando, there's tons of single-family homes being built here. And so far, that seems to be in balance and doing pretty well.
Landlords, investors, and lenders always enjoy seeing lots of long-term leases in office space. If you guys looked out into the future, let's say in 10 years, with the rate of evolution and change going on in the business world, where we're seeing more and more short-term leases, what percentage of a Class A office do you think would be occupied by, let's say, a long-term tenant versus those with shorter-term tenancy?
Well, I think we talked about it. I think it's changing. You're going to see more and more of those kind of flexible leases. The question is, does it become like a hotel? And that might work great, but as long as you can get value for it and people will underwrite it, that you'll continue to maintain occupancy even though you don't have long-term leases. So, I mean, we're thinking about that and looking at that because, in theory, you'd only do that if you're getting a better rent for that short term. But if you get better rent, but somebody can't underwrite the right cap rate for it on the exit, it doesn't do you much good. So, I mean, it's a balance, and it's evolving, and we're constantly looking at it.
Yeah, I agree with that. And, the key is not always looking at the face rent. It's the net effective rent and what the concessions are to get that long-term tenant versus that short-term tenant. And that's always been like one of the dirty little secrets of office, the CapEx that people don't underwrite and the concessions you have to underwrite to fill buildings.
Well, I never try to buy a building that's got that big of a chunky tenant long-term in it anyway. I'd rather, if I got a long-term tenant, I'd rather have him be, 25% of the building versus half. But to do that, you've got to build out your build-out right, that it can be reused. And that's the trick right now. And I don't think anybody's actually solved that yet. Because if you've got if you got short-term tenants getting higher rents, but if you got to continually change the capital on that, it'll kill you.
And in the markets where we really transact, I think when you define a long-term lease, it's probably over 10 years, and I don't think that is a more than 50% of the market type of stat. Not in Manhattan, not in Washington D.C., except for government leases, which tend to be longer, but they also have ways to get out earlier. So, is it the hard term or the soft term that we're talking about? But I tend to agree with the way you're looking at it, Jim. It's market standard to have probably more like 5 and 7 year leases than it is to have 15 and 25-year leases.
Then blenders.
It's funny. I found that there is no consistency at the moment between lender appetite. Lenders are changing, and some are acting like banks, some are acting more like insurance companies, and some banks are acting like insurance companies, and they all have different risk tolerances. So, what I thought would have been a really hot asset to look after for a lender had a 7-year lease on it for a majority of the building, and they were all nervous about, at year 5, what's the next buyer, the next lender going to see when there's 2 years left in the roll. So at this point, it's really hard, I think what you were alluding to is maybe lenders are more conservative than the equity. I think you're right. Where rates been held them down. Now you're seeing as rates tick up. Now their lack of aggressiveness is starting to show up a little bit. But you can find, if you use your resources, if you're working with Eastdil and the like that kind of know the whole landscape of the lending universe, you can find the lenders that do have the tolerance for a variety of things, whether it's a spec building. While it's not a deep market, there are a few that are out there, whether it's construction in a tertiary or secondary market for multifamily, or whether it's a long-term lease in the middle of Manhattan. I think there are lenders out there for all of that. It's just different fields, different folks, and you have to be smart about how hard you're looking.
Appreciate the plug.
Anytime.
Well, thank you. This has been a great discussion, and appreciate the opportunity to be up here with you guys. I think right now there's a break, and then the next panel will start at 4:30.